Good morning everyone. The purpose of this video is to go through the suggested solution to Matlabas Limited, which was your IAS 2 and IAS 8 assignment. As always, the first thing that we do when we get a question is we go and read the required. The purpose of reading the required first is so that you can actually understand and comprehend exactly what is being asked of you. And by knowing what is asked of you, you can then go and collect and, more importantly, recall the correct information from the information provided. So the required for this question was to prepare the adjusting journal entries for the above mentioned information in the General Journal of Matlabas Limited for the years ended 30 September 2014 and 30 September 2015 in accordance with IFRS. Note, the 2014 accounting period must be reopened for the purposes of processing adjusting journal entries. Journal narrations are not required. Journal dates are required. Round all final calculated amounts to the nearest rand, but do not round any per unit cost for the purpose of calculating the inventory balances. Ignore all taxation implications. Matlabas Limited uses the perpetual inventory system and indicate which part of the annual financial statements will be affected. Right, so we know we need to prepare adjusting journal entries, so it sounds like there is potentially an error or a change in accounting policy or something that has happened. We then also know that the 2014 accounting period must be reopened for the purposes of processing adjusting journal entries. So what that means is when you prepare the 2014 specific adjusting journal entry, you can have revenue, cost of sales, other expenses, whatever it may be, because you have reopened the accounting period in your journals. So that means it doesn't necessarily need to be taken to retained earnings. You can affect revenue, cost of sales, other expenses, whatever it may be, directly. Right, now we can go and read the information. Matlabas Limited purchases for resale, inter alia, certain merchandise. This merchandise has been valued using the weighted average method. The following is an extract from the management reports for this merchandise applying the weighted average method. So we have the opening inventories, purchases, cost of sales, and closing inventories for the year ended 30 September 2013 and for the year ended 30 September 2014. Now remember, it is the year ended 30 September 2014 that we can go and reopen. The closing inventories balance for this merchandise on 30 September 2014 comprises of 112,500 units. So that 405,000 Rand relates to the purchase of 112,500 units. On the 30th of September 2015, management decided to value the above-mentioned merchandise using the first-in, first-out method, as this would result in more relevant and more reliable closing inventory values due to the turnover rate of this merchandise. So here we have a change in accounting policy. The effect of this change has not yet been taken into account in any amounts as of yet, so that is why we have adjusting journal entries. The closing inventories balances for this merchandise at cost using the first-in, first-out method of valuation would be as follows. So on the 30th of September 2013, closing inventories would have an amount of 345,000 Rand, and on the 30th of September 2014, it would have a value of 515,000 Rand. The following transactions for this merchandise occurred during the financial year ended 30 September 2014. So on the 1st of November 2014, we purchased 1,800,000 units at R3.90 each for cash. On the 31st of January 2015, we sold 1,040,000 units at R6.50 each for cash. On the 30th of April 2015, we purchased 220,000 units at R3 each for cash. And on the 31st of July, we sold 910,000 units at R7 each for cash. So we know that we use the weighted average method and we have the perpetual inventory system in place. So when you see perpetual inventories and weighted average, we know that we need to prepare a table. We cannot just use the weighted average fraction. The net realizable value of all inventories at the end of each financial year exceeded the cost thereof, valued on both the weighted average and the first-in, first-out method. Right, that is the end of the information. Now, if we just go back up, you'll see that I have little notes on the page in purple. Now, when I first read this question and when I actually physically did the question, these were the little notes that I made on my piece of paper. So the purpose of writing the little notes on the side of each paragraph is so that you remember key information from that paragraph, so that when you start actually going and answering the required, you do not have to go and reread every single paragraph. So I know, okay, paragraph 3 tells me there was a change in accounting policy. Cool. What did I use? I used the weighted average and I have the perpetual inventory system in use. I'm changing to the FIFO method. I know that because we originally used the weighted average perpetual system, I know that I need to prepare a table to determine what was the closing stock for the year ended 30 September 2015 under the weighted average method. So these little notes just help you to place each paragraph so that when you start answering the required, you do not have to go and read the information from scratch. The first journal entry that we will be looking at is the journal entry that would be processed for the year ended 30 September 2013. However, this journal will only be processed on the very first day of the 2014 financial year, so the 1st of October 2013. And the purpose of this journal is to go and correct the inventories balance at the beginning of the year and to go and correct the profit from the previous year through retained earnings, as we are not reopening the 2013 financial year books. So you can do this one of two ways. You can go and look at the inventory implications or the profit implications. So here I'm going to show you both. So first things first, if you go and look at the inventory implication, at the end of the 2013 financial year, on the weighted average method, the closing stock has a value of 320,000 Rand. However, we know that we are now using the FIFO method of valuation, and according to the FIFO method of valuation, the value of the closing stock should be 345,000 Rand. So the difference between the 345,000 Rand FIFO and the 320,000 Rand weighted average is 25,000 Rand. And we know that the FIFO value is greater than the weighted average value, and therefore inventory needs to increase by 25,000 Rand. So if inventory increases, we have to debit inventories, and that means that we would then go and credit retained earnings. But now, to understand why retained earnings is credited, we can go and look at the profit implication. So to calculate the cost of sales using the weighted average method, we know that cost of sales can be calculated by saying the opening stock plus purchases less closing stock. So there was no opening stock in 2013, purchases amounted to 6,900,000 Rand, and closing stock under the weighted average method was 320,000 Rand. So that means our cost of sales would be 6,580,000 Rand. If we then go and work out the cost of sales, if inventory had been valued according to the FIFO method, once again we had no opening stock, so it's 0, plus the purchases of 6,900,000 Rand, less closing stock of 345,000 Rand, which then gives you cost of sales of 6,555,000 Rand. The difference between the cost of sales under the weighted average method and the cost of sales under the FIFO method is 25,000 Rand. There is a decrease in cost of sales because the FIFO cost of sales is lower. If there's a decrease in cost of sales, that means that we have an overall increase in profit. And if we have an increase in profit, that means retained earnings should increase. And retained earnings is an equity item, and equity items increase on the credit side. We are now going to look at the implications on the year ended 30 September 2014. This general journal entry will be processed at the end of the financial year, which is the 30th of September 2014. Now on this slide, I have not gone and looked at the inventory implication and the profit implication. I've gone straight for the profit implication, as that is the one that makes the most sense to me and it gets you to the answer the quickest. So we know that once again, to calculate cost of sales, we take the opening stock plus purchases minus closing stock. So we now need to go and look at this from the weighted average valuation perspective and the FIFO valuation perspective. So if we go and look at the weighted average valuation perspective, we know that the closing stock in 2013 is the opening stock in 2014. So that closing stock figure of 320,000 Rand is our opening stock in 2014. We then know that our purchases amounts to 7,560,000 Rand, and we know that our closing stock is 405,000 Rand on the weighted average valuation method. That then means that our cost of sales is 7,475,000 Rand. We then need to go and look at this from the FIFO perspective. So from FIFO's perspective, the closing stock from 2013 is the opening stock for this year. So our opening stock in 2014 is the 345,000 Rand, which is the value of the 2013's closing stock under the FIFO method. To that, we then go and add the purchases of 7,560,000 Rand, and we deduct the closing stock according to FIFO of 515,000 Rand. That gives us that cost of sales should be 7,390,000. Now the difference between cost of sales under the weighted average method and cost of sales under the FIFO method is 85,000 Rand. But as you can see, the cost of sales under FIFO is lower than the cost of sales under weighted average. So we therefore have a decrease in cost of sales of 85,000 Rand, which leads to an increase in the profit for the year, which leads to an increase in retained earnings. However, we know that for the year ended 30 September 2014, we were told that we can reopen the journal. So because we can reopen the journal, we don't go and affect retained earnings. We can go and show the effect on cost of sales directly. So we know that cost of sales needs to decrease. Cost of sales decreases on the credit side, so we credit cost of sales and we debit inventories. So once again, because we reopen the books, we do not show an effect on retained earnings, we show the effect directly on cost of sales. So we debit inventory and credit cost of sales with that 85,000 Rand. Alright, now we get to the implications for the year ended 30 September 2015. And now for the year ended 30 September 2015, we were not given the closing stock values. So we need to go and work it out. So first things first, we're going to go and work out the closing balance of inventory according to the weighted average method. Now we know that because we have the weighted average valuation method and we use the perpetual inventory system, you cannot go and use the simple fraction, you have to go and do the whole table. So the first thing that you need to remember is that you start off with an opening balance of stock. Now they didn't explicitly tell you have an opening balance in 2015, but you had a closing balance of stock in 2014. So because you had a closing balance in 2014, you have an opening balance in 2015. And they told you that that 405,000 Rand was made up of 121,500 units of stock. So you start off with a balance of 121,500 units. You know that the total is 405,000 Rand, which means you can go and work out the price per unit to be 3.60 Rand. We then know that the next transaction we had was a purchase of 1.8 million units of inventory. These were purchased at 3.90 Rand per unit, which gives us a total purchases of 7,020,000 Rand. That of course affects your balance because now you have increased inventory and the total of your inventory has also increased. So now you have 1,912,500 units at a total value of 7,425,000 Rand. If you go and take the 7,425,000 Rand divided by the number of units, you then get a price per unit. Now I've just got 3.88 Rand sitting in the table. However, you were told in the notes section that you do not round off to 2 decimal places when working with the per unit Rand value. You have to keep the full value on your calculator, which is what I did when calculating my cost of sales. So if you were just going to go and take the sales units of 1,040,000 units and times it by the 3.88 Rand, you would not get the 4,037,647 Rand. You need to take the 3.88 whatever it is on your calculator. All right. So you then had a sale of 1,040,000 units. If you have a sale, that means you have less inventory on hand. So we then have 872,500 units at the 3.88 ... and that then gives us a total inventory value of 3,387,353 Rand. You will note that whenever you have a sale, your per unit balance does not change. It only changes when you have a purchase. So then, of course, we have a purchase again of 220,000 units at R3 each, which gives us a total purchase price of 660,000 Rand. That, of course, affects our balance. So we now have 1,092,500 units of inventory. You know that the total will be the 4,047,353. How did I get that? Well, it's a 3,387,353 Rand plus the 660,000 Rand. If I then go and take that total and divide it by the number of units, I then get a per unit balance of R3.70. Once again, if I remember correctly, I don't think it's R3.70 on the dot. So if it is not on the dot, you need to keep the rest of the decimals on your calculator when working out your totals. Then we had a sale of 910,000 units. We would sell them at the new weighted average of R3.70, which gives us a cost of sales on that sale of 3,371,251 Rand. That, of course, affects our balance because now we only have 182,500 units and they will have a total value of 676,102 Rand. So that means that according to the weighted average method, the value of your closing stock is 676,102 Rand. Now we have to go and work out the value of stock according to the FIFO method. So you can go and make this really easy for yourself. Based on the table, you know that you have 182,500 units on hand. You know that with the first in, first out method, whatever you had in stock first is what you sell first. So you would have sold your opening stock. You would have sold the 1,800 units that you purchased. So your closing stock must come from the very, very, very last purchase that you made. And your last purchase was for 220,000 units at R3 each. So of those 220,000 units, 182,500 of them are sitting in stock. And what did you purchase those 220,000 units at? R3 each. So if you take the 182,500 Rand times the R3, that then gives you a value of closing stock under the FIFO method of 547,500 Rand. Now that we have the closing stock balances according to the weighted average and the FIFO method, we can once again go and work out the profit implications by asking ourselves, well, what was cost of sales and what should have cost of sales been under the FIFO method? So if we first go and look at the incorrect cost of sales under the weighted average method, we once again know we had an opening stock of 405,000 Rand, purchases amounted to 7,680,000 Rand, and then the closing stock is what we calculated on the previous slide to be the 676,102 Rand. So if you take your opening stock plus your purchases minus your closing stock, you then get a cost of sales of 7,408,898 Rand. We then go and look under the FIFO method. So under the FIFO method, we would have had opening stock of 515,000 Rand. We know the purchases was 7,680,000 Rand, and the closing stock was calculated on the previous slide, and that amounted to 547,500 Rand. If we take opening stock plus purchases minus closing stock, we then get cost of sales to be 7,647,500 Rand. Now in this case, the cost of sales under the FIFO method is higher. If we have higher cost of sales, we have lower profit, which means lower retained earnings. But we are working in the year ended 30 September 2015, so we can go and make the correction to cost of sales directly. We know that cost of sales kind of increases on the debit side because all the amounts accumulate on the debit side, which makes it bigger. So if you go and take the difference between the correct cost of sales and the incorrect cost of sales, you then get that there needs to be an increase in cost of sales of 238,602 Rand. So if we increase cost of sales, we debit cost of sales. If we debit cost of sales, we then have a credit in inventory of the same amount.